Richard, we've been saying a long time on Lex, and indeed I said to clients back when I was a management consultant that for the big banks, unless you're a serious player in certain product types, you really shouldn't bother, particularly in the big kind of flow businesses and the fixed income businesses. And it was reported in our paper today that some big changes at Swiss bank UBS, particularly on that fixed income side, possibly 10,000 people to lose their jobs. What are the details of the announcement that we have heard so far?
Okay, what we've heard so far is, as you say, 10,000 in the fixed income currencies and commodities arm. Probably a large part of that will be in the middle and back office because a large amount of machinery does this stuff as well. But that is quite an important thing because they're also going to be able to retreat from, if you like, the trading business, and it'll just be left as a little bit of currencies and a little bit of government bond trading and some other credit products. But those will only be needed to the extent they support the wealth management, the more profitable wealth management business of UBS. So this is a huge restructuring of the investment bank, and it is the first major structural recognition by a bank that things have changed.
The first white flag in investment banking. And so the story so far suggests that it's going to leave sort of M&A, FX and cash equities. Like I said, quite a serious development for the banking sector. Do you think any others will follow? I mean, it's very positive news, presumably.
Exactly. Last week we had the report, the third quarter report from Credit Suisse, and there were still signs that they thought things were still vaguely okay, and one forgets the punch bowl is still very much there from central bank liquidity provision. But I think we've got Deutsche tomorrow. They're reporting Q3. We've yet to see Barclays. So Barclays is very much a fixed income house primarily, and then since its Lehman purchase in the US became a bigger equities house, they've probably got some thinking to do. And the thing to remember is that UBS itself wasn't in the top 5 in any or many products. It hasn't been in the last quarter and the first 9 months of this year. So I think it's an existential moment of an inflection point for the whole industry.
And let's not forget that the supposedly the businesses that it's going to remain in aren't spectacularly doing too well at the moment either. I mean, cash equities is very difficult, and we've heard that other banks are thinking of pulling back there. M&A volumes, as we know, are the worst that they've been in a very, very long time. So it's still not very easy for a bank like UBS.
It's going to be lean pickings, and we saw in the margin compression at Credit Suisse last week that their wealth management unit is still drawing in assets, but a lower margin, gross margin, 107 basis points. So we'll be looking very closely at UBS's wealth management margin. But you're right, I mean, equities are pretty flat at the moment. That's a core franchise of UBS, and their advisory division is the gilded portal through which deals come for that division. So I think there's going to be more attention on costs in those areas next. I'd imagine Sergio Motti, who joined as CEO in April last year, is going to turn his howitzers onto those areas next. And these businesses have got to wash their face, otherwise they must just be canned. I'm sorry.
And of course, the gag, of course, for UBS is that they're hoping that their rating shifts from a sort of weak investment banking one to a slightly sexier wealth management rating, and I guess today's share price pop backs that up slightly. So thank you very much. We're eagerly awaiting Tuesday.